The broadcast is now starting. All attendees are in listen-only mode.
Good evening, everyone, and welcome to the July edition of Digging into the BI. This is where members from the Maryland and the DC regional chapters get together and be able to look at the latest edition of the member-only magazine, the BI, and we're going to dig into that and be able to use that in your BI membership to come up with 4 new stock ideas to be able to be presented. And the 4 that we're looking at tonight, starting in the upper left, is Molina Healthcare, Alphabet, ARM Holdings, and then Meta. So we have 2 new young startup companies in Alphabet and Meta, but I'm sure you guys will be able to make it through. Let's go to the next slide. So here's our standard disclaimer. We're doing these presentations for educational purposes. It's not intended as a recommendation for a buy, hold, or sell of any particular stock. We believe, as Better Investing does, that investors should conduct their own review and analysis of any company. And we may own some of these securities either in our clubs or in our personal portfolios. We try to alert you to it, but we may miss on some of those. And if we're showing you something outside of the resources of Better Investing, we are not endorsing or promoting those particular websites, products, or services. And as you can see with the blue underline there, anytime you see that, that's a hyperlink. This session is being recorded and it will go up on YouTube. So let's go to the next slide. And this is a little bit about Better Investing. Again, I see many of you are regulars and obviously are members of Better Investing. But if you're seeing this up on YouTube or the like, and you want to know a little bit more about us, we're an investment education organization. And we focus on long-term fundamental investing. There are many ways to invest. This is just the way we choose to do it. And all of the people that are presenting here tonight are volunteers in the Mid-Atlantic region. And if you don't have to be a member of Better Investing to participate in this program, nor do you have to live in Maryland, DC, or Virginia. We're glad to have any of you here. So let's go to our next slide. And here's the YouTube page. We're slowly gaining a little bit of a membership there. It's not as big as some of the other big influencers, but hey, we'll take it one step by step. But up here, Digging into BI is our channel, and you can be able to see all of our previous presentations are there. They're free. You can share them with others that you see in there. They're organized in chapters. You can see that over on the right-hand side. That just sort of breaks it up so you can advance directly to the stock you wanted to be able to listen to. And we ask in return for that, that since this is a free program that you get from us, is that if you like the video, share the video and make sure to subscribe to the channel. That's how we grow this community, and that's how the algorithms work for YouTube, which happens to be owned by Alphabet. Next slide. And so we haven't had too many troubles in terms of people getting on like we have before. But if you do have any trouble, you can usually find out with the audio. It can usually be because where that sort of purple arrow is going off up and to the right, people may not have their computer audio on their computer phone. But the other thing is that the green handout, the green line goes to the handouts. And in there, we have the 4 completed SSGs as a PDF, as well as a PDF of these slides. You're welcome to take them and share them with people in your club or be able to talk with other members about it. Certainly fine. Next slide. So what we're going to do in just about an hour is we're going to show you, what we like to do with this is that we believe that a lot of folks, even after they've maybe taken the basic SSG class, and that's a stock selection guide for people who don't know it, and they're maybe still uncertain of their judgments. And the only way to get better at it is to be able to practice. So we're trying to show you sort of best practices. We're trying to be able to promote the 2 model clubs that we have in the area. And it's also a way for our 2 chapters to work together. And we also want to be able to promote other clubs in the area. And if you're not a member of Better Investing, that blue underline up there gets you a link to where you can be able to get a free 90-day subscription to Better Investing. But we would like you to be part of it. In fact, Larry will be presenting, I think he'll be our 17th different club that will be presenting tonight. So thank you, Larry. Next slide. So in just over an hour, we're going to present 4 stocks. 2 that are called featured stocks. They come from the member only magazine. That's the stock to study and the undervalued feature. And then we're going to get 2 other presentations that come from somewhere by using your Better Investing subscription. It can be from the website or the magazine. And in this case, both of the stocks that are coming from there came from predefined screens. So again, it's just a way to be able to show all the different ways that you can be able to get a lot of educational and stock ideas just through your membership. And some of the other places we get it are all those listed down at the bottom. Next slide. So again, whether you're a member or not, you can be able to see a listing of all the upcoming featured stocks, a stock to study, an undervalued feature. These 2 were announced back in April and the like. In fact, they already have August and September ideas up there. So you can be able to take a look at it. And it's really great if people actually practice or do their own SSG on those featured stocks in advance of the presentation so we can have a discussion afterwards. It always makes it a little bit more robust if you do that. Next slide. So we also want you to be able to show you how to be able to get future announcements. There's a place where you can get the way to get into it is if what you see where that red circle is up in the sort of top center, which is my account. If you click on that, you'll go over to the left-hand side where I also have the my account, and you go down to the email and product subscription information. And if you click on that, that will open up that green box over on the far right. And you can do a couple different things. Where the arrow is pointing to, you can be able to get our local chapter news and events. If you're in the Maryland chapter, which is everything in Maryland except Montgomery County, you will get that stuff. And if you're in anywhere in the state of Virginia, DC, or Montgomery County, Maryland, you will get the DC regional stuff. So you can click on that to make sure you get it. And if before you do that, go up to where that yellow highlighter is and make sure to sign up for the Better Investing Weekly e-newsletter. And then go down and make sure to hit Save Changes, and you will now get all the information that's coming out from headquarters and from the chapter. Next slide. So here's the e-newsletter. This is the one that actually came out just on Thursday. It's for members only, but it highlights a lot of the education that's going on in our community, usually out of the headquarters in Detroit. It comes out around the close of business of Thursday. And if you don't see it, I suggest you check your spam filter because it may be already there. 2 of the things that sort of caught my my fancy was where that orange arrow is, a light orange, is the first cut stock reports. There's some really interesting ones that came on up that caught my eye. And so you can take a look and see what other people in our community have done. And then just below it, the blue arrow with the red highlight around it is they're going through stuff showing you the Learning Center, a beginner's guide to using the core SSG. So if you have someone who doesn't know how to use it or is a little uncertain, that's a great walkthrough to go with. Next slide. You can also join us on Facebook. Um, and that is a joint program from both the DC and regional chapter and the Maryland chapter. Don't have to be a member of the Better Investing community, but it's an opportunity to be able to see our stuff there. And if you want to be able to feature your own club and you're on a Facebook, you can go ahead and like us, and then you can tag us, and therefore it gets out to other people to see it. So consider that as a way to outreach into other people. Next slide. This is the stuff that's coming in from the Maryland chapter. I don't think we have anyone from the Maryland chapter in the back today, but they have from their stuff is that they're having Jackie Koski, who's a national speaker, coming out at the about a month from now to Linthicum Heights, and they're going to be doing a presentation there on Pathway to Wealth. So you can sign up for their. It costs us $35. The other thing is I'll tell you is that their newsletter is really, really good. And if you go into their stuff under local events and you look down under news and articles, you will get their magazine to see it. Again, you don't have to be a member of the Maryland chapter to see it. Anyone can take a look, but it's highly recommended and very good. Next slide. Cheryl. Do you want to tell us about the DC chapter? And if you're speaking, you're muted.
And I'm now unmuted. Okay, we have a lot of regular events that we put on monthly, including this one, the Digging into the BI in August will be on August 4th. And we have two model investment clubs, the Northern Virginia McNova, and we have MCMC, which is out in Montgomery County, Maryland. All of these are virtual. And so if you go into the local events and click on them, you will see the link to take you to any of these events. And please stay tuned because we are trying to get together an SSG class, which will also be online sometime in September. Back to you, Kevin.
All right, let's keep moving. And this is Ken. You want to tell us about your club?
So Happy Destiny Investment Club was started in 2001. Currently have 7 partners. We meet on the 3rd Friday of each month. With our upcoming meeting, we will be talking about tariffs as part of the education. And I will be presenting Texas Roadhouse as the stock presentation. If you have any questions, there's the point of contact if you want to reach us, as well as the link to actually join us this coming Friday.
Very good. Thank you. Let's go to our next slide. And Florentia, why don't you tell us about your club?
Sure. So I am a member of the Montgomery County Model Investment Club, and it's based in Montgomery County, despite us mostly meeting online, except for socials. It started in 2017. We have six partners, and we meet on the 3rd Wednesday of every month. We have a meeting on Wednesday, and it starts at 7, from 7 to 9 online. The link is there if you'd like to attend. We would love to have you. You can also dial in, and then, of course, we have an education component, and this week it's going to be using Notebook LM for investment research. And then the stock study that we are going to be focused on is United States Lime and Materials, USLM. If you'd like to reach us, that point of contact information is down there. And again, we'd love to have you.
Thank you, Florentia.
Thank you.
All right. Next, our newest presenter, Larry, tell us all about your club.
Okay. We're the Black Money Investment Club. We started in 1995. We currently have 9 partners. We meet the first Monday of the month at 6 p.m. in Fredericksburg, Virginia, and that's my email there. That's it.
Very good. And you guys just had your meeting, so you can't tell us what you're going to be studying.
No, not off the top of my head.
Okay. Cheryl, tell us about your club.
Hi, I'm a member of the Model Investment Club of Northern Virginia. We currently have 14 partners, started in 2008. Next, the meetings are actually they've been changed to the 3rd Tuesday of the month, and so that will be August 19th. Sorry, it didn't make it onto the slide. They are from 7 to 9 p.m., and there is the online link. Education and stock study are to be determined. There is the point of contact in case you want to drop us a line, but we would be happy to have you drop in. Guests are always invited and free. All right, so I've got this one as well. This is a fairly new program called Club Connect. And what it does is you have clubs that are looking for new members. You can fill out the form and talk about your club, and it will go out to people who are looking for clubs. So it's meeting both needs of the person trying to get a new member in and somebody that wants to go from being an individual investor to being a club member. There's a program is for BI members, BI clubs, and also for people who go into the free 90-day membership. So please give it a try if you are in either of those two situations. Thank you.
Okay. And so since this is digging into the BI, we like to be able to get you to look into the magazine, whether it's the paper version, as many of us do, but you can get it quicker on either the e-magazine or through the app on your phone, on a tablet, uh, computer, whatever you want to in terms of electronic device, there's a way to get on there. So consider it as a way to go. And let's take a look at the next slide. And this one sort of caught my eye, this article. Well, here I'm going to first show you, this is how you'd be able to get into this, is that if you want to be able to get onto the Better Investing magazine for mobile devices, click where that green arrow is, click on that, and they'll walk you through the steps to be able to make sure that you can be able to look at it. Otherwise, you'll just get the preview. The other thing is that where that red arrow is, the analyst reports and other resources. Anytime you see one of the featured stocks, again, the stock to study or undervalued feature are considered featured stocks. In this location right there, you can be able to get the additional information that's usually mentioned in the article. So it's a great way to be able to find more information about what's going on. And you can also find the issues, the old issues, where the green icon is in the middle, where it says View Magazine Issues, to get that as well. Next slide. And here was the article that caught my eye. This is the cash flow column. And it was talking about how maybe the 4% rule, that you could take out 4% from your portfolio and you would never go broke. That's something I found this a really interesting article to be able to take a look at. So go ahead and read that and see if that applies or is something that interests you. Next slide. And here are the upcoming events. There's really not a lot in July. There is one that's already in August. The Arizona chapter is having Betsy Wills, one of the national speakers, speak there, and it's online and free. So that's great with a lot of these events. You can find them anywhere. There is one in person on our side of the coast, and that's going to be the 11th annual Investors Fair from the Georgia chapter. It will be in person, so you have to head to Atlanta. Ken and I just got our airplane tickets. We're going to head down there and see some of the people in Georgia. It's just a single day, but go ahead and consider, if you're close by, to go there. They have a nice lineup of speakers. Next slide. And now here are the two stocks we're going to look at in core, although I think one of them is in plus. But we're going to have Ken tell us about Molina Healthcare, where he found it. And then we got the undervalued feature, Alphabet, which our newcomer Larry is going to be able to run through. So let's go to the next slide. And Ken, you get us started.
Good evening, everyone. So I am presenting Molina Healthcare, which is a Fortune 500 company, and it trades on the NYSE. Next slide, please. And I found it using the value screen, value predefined screen on the Better Investing website. And this is a company that is in the healthcare sector. But next slide. So just as an overview, as I just mentioned, it's a company in the healthcare sector. The industry is healthcare plans. It is a large size company. It provides managed care healthcare services under Medicaid and Medicare through state insurance marketplaces. They have about 4.9 million Medicaid members, 403,000 ACA marketplace members, and about 242,000 Medicare members. If you had invested $10,000 5 years ago, it would be worth $16,572 today. Next slide. So just kind of as a corporate timeline, the company was, this is kind of a founder-led business. It was founded by Dr. C. David Molina, who was an emergency room physician, who opened the first clinic to serve low-income patients in Long Beach, California. And that was back in 1980. In 1994, the company transitions from a network of primary care clinics to a licensed HMO plan. Dr. David Molina passes away in 1996. So he has two sons, Jay Mario, who becomes the CEO, and his other son, John, who becomes the CFO, and they lead the expansion beyond California into other states. In 2003, the company goes public to raise capital for further growth and is listed on the New York Stock Exchange. And then in 2006, they enter the Medicaid market. In 2010, the company expands into the Medicaid Management Information Systems, or MMIS, the acquisition of Unisys Health Information Business. And then in 2017, both sons kind of stepped down from leadership in the company, and a new CEO is appointed, Joe Subretsky, who is now the current CEO. Next slide. All right, so to give you a sense of their geography, they are in 21 different states, offering some form of Medicaid or Medicare or an ACA marketplace HMO plan. Looking at their income, they had approximately $38 billion in 2024. 79% of their revenue came from Medicaid participants, 15% from Medicare, and 6% from marketplace participants. Next slide. Okay. Yeah, we can advance to the next slide. Okay, so for the Medicare medical memberships across the markets, so their competition would be Centene, Elevance, United Healthcare, and CVS Health. Molina has the biggest share of the Medicaid participants in the plans they offer at 92%, followed by Centene, Elevance, United Healthcare, and then CVS Health. And then when you're looking at some of your commercial plans, CVS Health and United Healthcare seem to dominate there. And then with respect to Medicare, it would be, again, United Health and CVS that seem to dominate there. Next slide. Can we go back one? So one of the ratios that is common in among companies in the healthcare plan industry is the what's called the medical loss ratio, or the medical care ratio. And this is a ratio that seems to be a two-edged sword. As we can see, United Healthcare has the lowest ratio at 84.8, which means that they tend to deny about, say, 15% of their claims. However, they are one of the most profitable companies because of the claims they deny. On the other end of the spectrum, we have Molina Healthcare that has a medical loss ratio of 89.2%, meaning of their competition. They may deny about 10% or so of their claims, and they don't have as many lawsuits against them as a result of this. Next slide. So in terms of competitive advantage, they have a specialized focus. They've created deep expertise in Medicaid programs, which larger diversified insurers may lack. In terms of scale and geographic diversity, the company's smaller size provides agility and focus, and the company has more selective presence in 16 states and Puerto Rico, which allows them to be focused on market penetration in selected regions. They have cost management expertise, which has maintained competitive profit margins, indicating effective cost management and operational discipline. They have a pretty good technology infrastructure. The company has targeted innovation in care management for vulnerable populations. They have regulatory relationships. They actively engage with policymakers and regulators to advocate for stable, predictable program funding and reasonable regulatory requirements. And then finally, they have value-based care models, which means they have sophisticated care management capabilities due to its focus on high-need populations. Next slide. So they are strategically positioned. Their Medicare segment is largely comprised of dual products with significant overlap of Medicaid plans in 16 states that they leverage their Medicaid footprint. So they're able to offer other plans in addition to the Medicaid plans that they have in 16 states where they are within the country. Next slide. And then doing the SWOT analysis here, they have specialized expertise in government programs. So they have developed deep expertise in managing government-sponsored healthcare programs, strong revenue growth trajectory with about 19.3% year-over-year revenue increases in 2024, and a 5-year compound annual growth rate of approximately 20.3%. They've been improving their financial profile. They have significantly improved their debt to equity ratio in 2024 and strengthened their balance sheet. They have great operational efficiency despite its smaller scale and relative to its to other industry giants. Molina has maintained competitive profit margins and has improved their asset turnover ratio. And then with respect to strategic diversification progress, while maintaining their core Medicaid focus, they have successfully expanded Medicare and marketplace segments. Taking a look at some of their weaknesses, there's some scale disadvantage with about 41.9% in trailing 12-month revenue. Molina operates at approximately 1/10 the scale of United Healthcare and 1/4 of Centene, which is their two probably largest competitors in the Medicare space. And then with respect to Medicaid concentration risks, despite diversification efforts, Molina still derives about 73% of its revenues from Medicaid programs. Geographic limitations. Molina's presence in 19 states and Puerto Rico limits its ability to leverage scale across all markets. They do have a higher medical loss ratio at 88.2%, slightly higher than their peer average. Taking a look at some of their opportunities, they have Medicare Advantage expansion, Medicare Advantage market opportunity. Market continues to grow rapidly in the U.S. population, and Medicare Advantage penetration increases. With respect to Medicaid program expansion, several states continue to expand Medicaid eligibility or shift more beneficiaries to more managed care arrangements. With respect to value-based care transition, the healthcare industry shift toward value-based care models present opportunities for Molina to leverage its care managed expertise. With respect to acquisitions, the company's improved financial position and demonstrated integration capabilities create opportunities for continued strategic acquisitions. And then in terms of threats, regulatory policy and uncertainty, as the company is heavily dependent on government programs, Molina does face significant exposure to regulatory challenges. Medicare Advantage rate pressure. They do have pressures for 2025 and beyond that could impact the profitability of this growing segment. And then with Medicaid redetermination, voluntary ongoing Medicaid redetermination process creates enrollment volatility and potential membership losses, especially as a result of the recent bill passed by Congress. And then finally, intensifying competition as more players come into the market. Next slide.
4 minutes, Ken, 4 minutes.
Okay. So just taking a look at the most recent value line, you can see that they currently trade at a 12.8 PE with potential expansion going up to 16.5 in the next 3 to 5 years. If we look at the cash flow line there on the graph, they're trading slightly below it, which would indicate they're slightly undervalued. Looking at the 2028 to 2030 projections, they have a annual total return range between 9 and 21%. Value line is just estimating their revenues 3 to 5 years out to be about 9.5% and for earnings 10.5% respectively. So they're ranked to outperform the broader market averages in the year ahead, according to the analysts. So next slide. Okay, so looking at the long-term premium revenue growth targets, they're looking to, there's a lot of their growth is organic, so they're expecting Medicaid participants to grow 7 to 9% a year, Medicare by 12 to 14%, and then the marketplace 5%, with a weighted overall growth between 7 and 9%. So you can see a good portion of that is organic, and then about 4% of that is through acquisitions. Next slide. So for the front side of the SSG, we see things that are pretty much up straight and parallel. They're trading at near their 52-week low here, which is why it probably showed up on the value screen. For the most recent quarter, their sales were at 12.2% and the EPS was at 5.4. For my judgment, I'm using 8.4% for the sales and 9.5% for EPS. Next slide. And then you can see that they have had a bit of a dip here on the return on equity. The pre-tax profit is pretty much in line with its 5-year average. So when you have situations like this where the return on equity is below the 5-year average, it can be helpful to do what's called a DuPont analysis. And this is simply a framework that will help you to better understand the drivers of return on equity. So the components that go into it are profit margin. We can see if you divide the net income divided by revenue, that's about 2.9%. The asset turnover, which is about 2.9 here. Financial leverage, you divide total assets by shareholder equity. And then the return on equity, which is the profit margin divided by times asset turnover over time financial leverage. So the insights that you kind of gained, I was able to kind of gain from this is the 90% MCR rate indicates cost pressures from Medicaid redeterminations and utilization. The asset turnover, strong revenue growth at 9% year over year, and membership expansion have been driving high turnover. Financial leverage, stock repurchasing, and debt obligations maintain moderate leverage, amplifying their returns. And then for ROE at 25.1%, it's competitive. And it's driven by operational efficiency despite margin constraints. So the overall assessment was that the company exhibits strong financial health with effective capital deployment through margin management and remains a key area of focus for a key area for operational focus. Next slide.
2 minutes. 2 minutes.
Okay. So in looking at their price earnings history, we can see that at the current PE at 11.6, they are trading well below their 5-year average earnings PE of 19. And the average high PE here seems to be about 23.6, and the average low PE is at 14.5. They do not currently pay a dividend. Next slide. I selected 19 as my high PE and 10.6 as my low PE. And I wound up selecting the 4BB option for my low price of $151.30. That's my low price. That results in an upside downside ratio of 5.7 to 1. Next slide. And that gives me a 5-year potential in the range of 16.8 to 22.8%, which is kind of within the 5-year projection of annual return that is being given by Value Line, shown over here in the right. Next slide. So in conclusion, the company is a large-sized growth company. I believe it's well managed. It's undervalued as it's trading below its 5-year average PE. It's a buy for $268.30 with a 5.7 to 1 upside downside ratio and a 22.8 trailing return. And I believe it's a candidate that is worthy of your consideration. Next slide. So the core thesis here is that the company represents a compelling investment opportunity with the potential to outperform the broader healthcare sector as its managed care peer group over the next 3 to 5 years. Their specialized expertise in government-sponsored healthcare programs, peer revenue growth trajectory, improving financial profile, strategic positioning, and expanding market segments. Great favorable risk-reward profile for the company going forward. Next slide.
Thank you very much, Ken. And
Larry.
Larry, you get to take over. And just to let you know, Larry's going to be our 42nd different presenter since this program started almost 5 years ago. 24th different one just this year alone. And he now brings our 17th different club. So Larry, welcome to the fray and tell us about Alphabet.
Hi, yeah, this is Larry Graybill, member of the Black Monday Club. I did a quick check on our August the 4th meeting. We're going to be discussing LCII access and literally FYI. But today, I'm discussing Alphabet, which is, you've all heard of it, the American-based holding company best known for Google search. It was the BI Magazine July 2025 Undervalued Stock Selection, and it is number 4 in the top 100 companies held by BI members. Okay, next page. This is an excerpt from the July BI Magazine article. The key takeaway here is the lawsuits filed by the Department of Justice alleging that Alphabet is illegally monopolizing the search engine market. Significant part of this case revolves around Google's agreements with Apple and other mobile carriers to be their default search engine, paying billions of dollars annually to maintain the status. Remedies have not been proposed, but whatever happens, Alphabet will certainly appeal the decision, which could tie up the case for years. There's more stuff there, but well, okay, next page, please. Okay, some background. Alphabet originally started as Google in 1998. Larry Page and Sergey Brin, graduate students at Stanford University, where they developed a search engine they called Backrub, which could analyze backlinks pointing to a given website. They launched the Google search business in 1998. They chose the name Google. It's a mathematical concept. It's number 1, followed by 100 zeros as a Google. After some 6 years of growth, Google went public in 2004, and they acquired various subsidiaries, Gmail, Google Maps, etc., and Android, which is currently the world's most popular mobile operating system. Okay, next page. Okay, now, Alphabet. In 2015, Google officially restructured and changed its corporate name to Alphabet. It was created as a holding company for Google Search and the other various subsidiaries. Sundar Pichai, who joined the company in 2004, was appointed to CEO in 2015. And today, Alphabet is a very large cap stock with a market cap of around $2 trillion. Okay, next page. Okay, the stock. Currently, Alphabet has 2 ticker symbols, Goog and Google. I think the original ticker symbol at the IPO was Goog. In 2014, they had a 2-for-1 stock split, which introduced 2 classes of stock, Goog and Google. Google are the Class A shares, which have voting rights at 1 vote per share. Goog is Class C, which has no voting rights. There's also a Class B share, which are held by founders and insiders, and they have 10 votes per share. They're not publicly traded. But they did this so the Google founders, Larry Page and Sergey Brin, could maintain their majority voting control of Alphabet. And according to the 2024 proxy statement, they controlled 52% of the total voting power. And they had a 24-1 stock split. There's no preferred stock. There's about 12 billion shares outstanding. They recently had a dividend. It is currently 21 cents a share for the A, B, and C shares. And they also authorized a repurchase plan of up to $70 billion of the Class A and C shares. Okay, next page. Business, they're headquartered in Mountain View, California. In fiscal year 24, the revenue was $350 billion, 3rd highest tech company behind Apple and Amazon. Internationally, Europe, Middle East, and Africa accounted for about 29% of total revenue. Asia Pacific accounted for 16%, and the United States had the remaining 49%. Alphabet has 3 subsidiaries. Google Services includes its core search and advertising business. Google Cloud, of course, is the cloud on demand over the internet. And Other Bets houses their emerging stage moonshot businesses like their Waymo self-driving cars initiative. Okay, next page. Okay, they have a lot of subsidiaries. I'm not going to go over all these, but let's talk about a couple of them. They have Nest smart home devices. DeepMind is their artificial intelligence research laboratory, which is developing their Gemini AI large language model chatbot. Waymo, their self-driving cars initiative, currently offers fully autonomous paid ride-hailing services in 4 cities: Phoenix, Arizona, San Francisco, Los Angeles, and Austin, Texas. Waymo has had more than 10 million paid rides. Google Search is their largest subsidiary, makes money through advertising on their search result pages. Google Cloud is the 3rd largest cloud provider behind Amazon Web Services and Microsoft Azure. YouTube makes money through advertising and also through subscription services such as YouTube TV. Android is a mobile operating system that has a 72% market share compared to Apple, which is 28%. Okay, next page. Here's the income statement from the most recent quarterly report for the quarter that ended March 31st. You can read what it says. First quarter revenue was up 12% year over year. Net income increased 46%. Earnings per share increased 49%. Also, the operating margin expanded by 2 percentage points. Okay, next page. Here's revenues for the quarter broken down by business segments. Those first 5 lines add up to be the Google Services total line. And you can see that Google Search, YouTube Ads, Google Subscriptions, and Google Cloud each had double-digit growth rates. And okay, that's enough on that page. Next page. I did an SSG. You can see what the analyst growth estimates are. I checked Value Line, and their estimated 5-year growth rate is 13%. And the sales look pretty good. They're like basically a straight line. That looks pretty good to me. Okay, next page. Peer sales. I used peers of Apple, Amazon, and Microsoft. Alphabet compares favorably to these peers at the 2nd highest historical sales growth rate. Okay, next page.
5 minutes, Larry, 5 minutes.
Yikes. Okay, peer earnings per share. Again, they were 2nd highest. Okay, next page. Pre-tax profit. This is the evaluating management portion of the SSG. They had the 2nd highest pre-tax profit behind Microsoft, and their pre-tax profit has remained consistent over the years. And note their most recent value for 2024 is 34.2%, which is greater than the 5-year average. So they've been maintaining good profit margin and increasing it every year. Okay, next page. Return on equity is similar. 2024 value was higher than the 5-year average, and that's good. Okay, next page. Debt to capital. Alphabet has a very low debt value, mainly because their core businesses, search and YouTube, generate enormous cash flow, which allows the company to fund operations and share buybacks without needing to rely on external debt financing. They also have a significant cash reserve of $95 billion. So their debt looks pretty good. It's low. Okay, next page. Forecast sales. Long-term growth rate is 19.3%. Value line projection was 13.5%. I chose 13% as the forecast rate, and it resulted in a 5-year projected sales of about $663 billion. Okay, next page. Forecast EPS, historical was 26. I chose 13 again, giving an EPS of 16.53 forecast, which is similar to the analyst consensus estimate, which is 16.38. Okay, next page. Forecast high price, the average PE was 28.3. I chose 25 as the forecast high PE. Was keeping the peg below 2, similar to their 2024 number. It gives the forecast high price of 413.3, and our current PE is around 20, which is below the 5-year average. That's good. Okay, next page. Forecast low price. I chose a low PE of 15. Gives a low stock price of 134.6, which I chose to use as my forecasted low price, which is also close to the 52-week low price, which is 140.5. Okay, next page. turned out to be a buy below 204.3 with an upside downside of 5.1. It's in the buy zone. Okay, next page. Growth drivers, you can read what it says. AI is being integrated in Google search, leveraging to improve ad targeting. They're making infrastructure investments in AI infrastructure. Google Cloud is doing well, and they're gaining market share against their main competitors, which are Amazon Web Services and Microsoft Azure. They're also making acquisitions. They acquired cybersecurity firm Wiz, which is a leading cloud security platform recently. YouTube's advertising continues to climb. YouTube's a very large sharing platform. They have more than 2 billion monthly users with 1 billion hours of YouTube content viewed daily, which I thought was amazing. But YouTube subscription are also increasing. Okay, that's good. Next page. Competitive advantages. I copied this from the Morningstar Equity Analysis Report of June. You can read what it says. Basically, Morningstar assigns a wide moat rating. Alphabet has an overwhelming dominance in the global search engine market, as such that to Google something is synonymous with searching, and it's even in the dictionary as a verb. They currently control about 90% of the general search market, and they handle 9.5 million searches every minute. Its main competitor is Microsoft Bing, which is so far in second place that it allows Google to have significant pricing power. Okay, next page. Risks. They have lawsuits discussed earlier. Another risk is the impact of AI chatbots on your search business. And I actually asked Gemini, their AI chatbot, about this, and what it said was, user behavior is shifting. The rise of powerful AI chatbots like Google's Gemini could alter how users find information. If users increasingly get direct answers from AI without needing to click on traditional search results, it could reduce ad impressions, directly impacting Google's core search advertising revenue. So I thought that was interesting. But okay, next page. Conclusion, it's a very large cap with a market cap of around $2 trillion. Value Line gives it a financial strength rating of A++ and a price growth persistence of 100. It's a very well managed company. Pre-tax profit and return on equity have been increasing, and it's a buy below $204. And that's it.
Larry, that was very, very good. And I'm giving you a golf clap all the way from Baltimore for all your work there. Thank you very much. You did so well. We're
Okay.
going to bring you back pretty soon.
Oh,
That's your punishment. You got to come back.
no.
Anyway, here we are. We're going to do two stocks in SSG Plus. Cheryl's going to tell us about ARM Holdings. And then we're going to have the stock to study, which Florentia is going to be able to talk about. And let's just bring it over to Cheryl, and you tell us all about ARM Holdings.
I want to apologize if you hear heavy breathing in the background. I have a very nervous dog and a thunderstorm going on, so apologize for that. Anyway, ARM provides the industry's most efficient and highest performing compute platform with more than 310 billion ARM-based chips shipped to date. The world's biggest technology companies, including AWS, Microsoft, Google, Meta, NVIDIA, and Samsung, are innovating on ARM, all with the shared purpose of meeting the insatiable compute demand required to deliver the unprecedented capabilities and experiences that AI promises. Together with the world's largest computing ecosystem and over 22 million software developers, they are achieving the impossible from cloud to edge by building the AI experiences of the future for everyone. ARM Holdings Architects develops and licenses high-performance, low-cost, and energy-efficient IP solutions for CPUs, GPUs, NPUs, and interconnect technologies relied on by many of the world's leading semiconductor companies and OEMs, or original engineering material, to develop their products. In short, ARM licenses the instruction sets for modern chips to partners who then make the chips with customizations for their unique applications. Their trusted computing platforms deliver the right combination of common software standards and foundational hardware building blocks, giving our partners unmatched flexibility in bringing innovative, specialized processing to their products while enabling differentiation where it truly matters. Key business aspects. Business model. ARM Holdings licenses its processor designs, or IP, to semiconductor manufacturers, earning revenue through licensing fees and royalties on each chip shipped. This model allows for broad industry, adaptation, and scalability without the need for costly manufacturing. Products and services. ARM provides a range of CPU architectures: Cortex-A, Cortex-R, Cortex-M, Neoverse, GPUs, Mali, Immortalis, MPU Ethos, and related technologies used in various applications, including smartphones, automotive systems, cloud servers, and IoT, or Internet for All devices. Competitors. Key competitors in the CPU market include Intel, AMD, and IBM, particularly in the server space. In the GPU market, competitors include Imagination Technologies, Qualcomm, and increasingly NVIDIA and Samsung. Stock performance and recent news. Stock performance. ARM Holdings stock has shown significant growth with a 31% gain in the first half of 2025. This performance is attributed to the AI boom, market share gains, and strong financial results. Shares of ARM Holding, ARM negative 1.72, continue to march higher in the first half of the year, benefiting from the broader tailwinds in artificial intelligence, market share gains, and solid growth in its earnings report. ARM licenses its central processing unit, or CPU architecture, to partners like Apple and NVIDIA, and is well positioned to capitalize on the data center boom and future growth in edge AI, as its architecture is more power efficient than the competing x86 alternative used by Intel and AMD. As a result, ARM continues to earn a high valuation since it has long runway of growth in the AI era. According to data from S&P Global Market Intelligence, the stock finished its first half of the year up 31%. ARM started the year on a high note before crashing on tariff-driven concerns and then recovered to nearly its previous peak. In its two quarterly reports, the company showed off solid growth on both the top and bottom lines through the stock, though the stock pulled back both times. In May, during the fiscal fourth quarter, the stock fell in part due to management's decisions not to provide full-year guidance, which was due to broader uncertainty in trade policies and the fact that its customers had also not provided guidance. Overall revenue rose 34% to $1.24 billion, paced by strong licensing growth, and operating income was $410 million, showing its impressive margins. Technology companies use ARM's architecture to design their CPUs and other chips. Once a chip is designed, the client can sell its own device, like Apple's iPhone or Samsung's Galaxy, or sell chips to other device makers like Qualcomm, which provides CPUs to smartphone makers. On top of licensing fees, ARM gets a royalty percentage of the value of the chips shipped. If a $1,000 smartphone has $50 of ARM content and ARM charges a 5% royalty rate to that customer, ARM gets 5% of the ARM content, or $2.50. ARM is exposed to long-term growth trends in battery-powered devices, data centers, and automotive. ARM royalty rates for its newest architecture, V9, are around 5%, double those of predecessor V8, according to management. As V9 represents a larger portion of revenue, ARM's blended royalty rate will go up. In the long term, ARM will continue to gradually increase royalty rates, underpinned by research and development reinvestment, which should lead to better chip performance and energy efficiency. Market position. ARM holds a dominant position in the mobile processor market, with its technology found in 99% of smartphone CPU cores. The company also expanding into new markets, such as data centers and AI, where its energy-efficient design offers significant advantages. Recent developments. ARM continues to innovate and expand its technology portfolio, including advancements in AI, security, and automotive applications. The company has also forged strategic partnerships with major technology players to drive adoption of its solutions in emerging markets. Financial performance. ARM Holdings has demonstrated strong revenue growth, with fiscal year 2025 revenue reaching $4.01 billion, up 24% from fiscal year 2024. The company's net income for 2025 was $792 million, a 159% increase from the previous fiscal year. The growth is driven by increasing adaptation of its latest technologies, particularly in AI and data centers. ARM is building the future of computing. It's one of the most pervasive CPU architectures, with 310 ARM-based chips in inception. Hold on a second, I need to get my, here we go. Control panel out of my way. 310 billion ARM-based chips shipped since inception. Everything today is a computer. CPUs are needed everywhere. Got 30.6 billion ARM-based chips reported as shipped in fiscal year 25. Ongoing innovation to support of customer needs, from CPUs to compute subsystems, 22 million software developers on ARM, and a strong growth, highly profitable, and cash generative company.
Four minutes.
Thank you. Recent news, ARM has set ambitious goals for capturing 50% of the data center CPU market, leveraging its energy-efficient designs and growing customer base. Recent partnerships and product launches further support this expansion strategy, positioning ARM for continued growth in the AI era. Renee Haas has been the CEO of ARM Holdings since February 2022, bringing extensive experience from leadership roles at NVIDIA and other technology companies. With the leadership team, comprises experienced professionals in various fields, including finance, engineering, sales, and marketing. This diverse and skilled leadership is crucial for driving ARM's continued growth and innovation in the dynamic semiconductor industry. ARM offers two main types of licenses, off-the-shelf and architectural. In the off-the-shelf license agreement, ARM licenses a ready-to-use portfolio of CPU designs that a client can incorporate into its devices. The portfolio spans from very simple CPUs to more advanced ones used in high-end smartphones or data center workloads. As you can see from the graph, when they started out in fiscal year 16, it was pretty much divided between mobile and other devices. Now in 2024, that has expanded to a broadening range of products, including CPUs and systems for markets such as cloud, automotive, and LOT embedded compute. Can ARM keep climbing? ARM still has a lot of growth in front of it, but given its high valuation, it may take time for the stock to move substantially higher. Still, the business is in an excellent position to capitalize on the AI boom. Investors may want to take advantage of any pullbacks in the stock over the rest of the year. Here we have the value line, which is saying that it's not for the faint of heart. They're surprised that the company's first quarterly earnings reduction was received so well by Wall Street, and this may speak to the exciting, sustainable growth opportunities ahead. All in all, investors able to endure risk should realize above average returns if our long-term projections are realized. And that was from June. What used to be Standard & Poor's is saying that it's a hold at 3 stars. The price right now, when this was written, was $145.94. Their 12-month target is 162, with a 3-year projected earnings per share of 38%. And Morningstar has assessed it right now as the fair value being way below the closing price, but it's got a wide moat and standard capitalization allocation. And they're expecting revenue to grow at 18% compound annual rate. Here we have the SSG.
2 minutes.
Thank you. And you can see it's pretty much been up straight and parallel since 2023. This is where the company reported a decrease in net income. There were also other areas of growth and positive signs for the future. As you can see, it's shown to be recovering quite well. Here we have the backside of the SSG. The current price earnings ratio at 194.6 is well below the 272.9 average. Also, take a look at columns D and E. You can see that the price to earnings ratio has almost come down by double and is continuing that decline by the current earnings ratio of 194.6. It is a buy at 5.5 to 1 with a potential price appreciation of 109.3%. Here is my potential gain versus loss thermometer. You can see that the current price is well within the green area of the buy and is not anywhere near the beginning of the hold. It again saying the 109.3 appreciation with 5.5 to 1 upside downside. The SSG results summary is showing the total return will be somewhere between 10.6% and 15.9%, with no dividend being paid currently. Conclusion, ARM is a medium-sized company with a Morningstar financial health grade of B. It's a well-managed company. It's currently overpriced, trading above its 5-year average PE, but I'm showing that it's not, that it is below that. However, these are the conclusions that it came out with. It's a buy up to $62.70, so there is where it's overpriced as compared to the $145 that it is currently. But if you look to buy it during that, with that 62.70, it will get down to 3.1 upside downside with 15% total return. ARM's a worthy candidate for a watch list or possibly as a small, more aggressive portion of a portfolio purchase, perhaps waiting for that dip in the market. And that is the end of my presentation.
Thank you, Cheryl. And last but certainly not least is that we're going to have Florentia tell us all about Meta. So go ahead, Florentia.
Okay, thanks for hanging in there, everyone. I am presenting Meta tonight, so if you could click on that video, this is the slide. So this is the future of Meta. They continue to innovate and find new ways to grow their brand. Next slide, please. The CEO is Mark Zuckerberg, who we all know, and the beginning came from a group of Harvard students, and they are on the right. Today, Mark Zuckerberg is the founder, known as the founder and the chairman, as well as chief executive officer of Meta, for both management as well as the board of directors. There are Class A shares, and he owns less than 1% of it. It only grants one vote each, and he owns 99.8% of the B class shares, which conveys 10 votes. Next slide, please. Meta Platforms. It actually has a mission to give people the power to build community and bring the world closer. The timeline of the company is that it was thought up in 2004, February, incorporated later in the year, 2006, open to the general public, May 2012. It had a public offering, and then most recently in 21, it adopted its current name, Meta. Next slide, please. The principles is to give people voice, build connection of community, serve everyone, keep people safe, and protect privacy, and promote economic opportunity. Next slide, please. The facts about Meta is that it is the world's social media giant, and it is one of the big five that was mentioned earlier. And it has a family of apps. These family of apps is one of the segments that actually drives the company and is the original, including Facebook, but it has had an acquisition of Instagram and WhatsApp as well. So it continues to innovate, as I mentioned, with Meta Horizon, Quest, the smart glasses, the Ray-Ban smart glasses, AI, Llama, as well as Workplace and Meta. So the primary revenue is from advertising, and the advertising is and impressed by the impressions, as well as based on impressions, as well as the clicks, and it's influenced by the factors based on the audience, targeted, as well as the ad quality and competition. They are undergoing a strategic shift to the metaverse that you did see in the reality labs. Next slide, please. Here are the core products, which we've already mentioned, so you can just glance at it in a kind of spaced way. The workplace that is at the bottom is being phased out in, I think it's June 2026. And that's like a business kind of Facebook where the company members can network and communicate. Next slide, please. Here are some of the products under the Meta Quest and Metaverse. So if you're unfamiliar with it, these are some of the items that bring in the revenue in addition to the advertising. So this is the segment for Meta Quest and Metaverse. Next slide, please. So looking at the advertising, which is revenue, which is the #1 revenue source, we can see that in the different quarters from 23 up until the first quarter of 25. Each quarter, if you look at it, it starts at a number that is not as high, and then we can see a continuous increase for every year for 23, 24, and now we've started with Q1 25. You can also see that it's a global company where geographically we can see it in the US and Europe and Asia Pacific, as well as the rest of the world. Next slide, please. The revenue by user geography, again, you can see the increase, and you can see how the segments around the world are being affected by user geography. We can see that in 24 as compared to 25, we can see that the amount is different, and you can see that along with the bars. Next slide, please. The segment results, once again, you can see it broken down into advertising, other, family of apps revenue, and the reality labs revenue. And we can see the total revenue here in Q1 25, but you can see that there's a steady increase in the revenue over time, as well as the operating margin as well. Next slide, please. The competitor revenue growth comparison is here. So I selected the competitors as Google, Microsoft, and Snap. Snap, as well as Pinterest, was suggested by Morningstar, and then the others were suggested by other entities, Microsoft and Google. So we can see, if we look down at the bottom, that the growth, historical sales of Meta outpaces all of them except Snap. And Snap basically is so much smaller, so it's not a real competitor because of the volume of communication services, which is the sector that Meta belongs to as compared to Snap. We can also see that the peer group average is higher. Meta is higher than the peer group average as well. Next slide, please. The competitor earnings growth comparison, once again, we can see that Meta, if we look at the graph as well as the chart at the bottom, that it is exceeding all of the companies of competitors, and Snap is way below, as well as the peer group average. Meta has actually exceeded that as well. Next slide, please. The competitor percent of pre-tax profit on sales growth comparison, and these are the same competitors. We can see that Microsoft is somewhat higher, and we can see the peer group average is 80%, whereas Meta is 36.3%. Next slide, please.
5 minutes. 5 minutes.
Thank you. Risks to consider. We have some lawsuits that are there pending with Meta, and they've been very public. So the FTC Commission has, the FTC has antitrust lawsuit against Meta, saying that it maintains a monopoly on personal social media network services and the market as a whole. And that was definitely realized when they acquired Instagram as well as WhatsApp. So there are implications on both sides, whether they win or lose, as well as another lawsuit is from the parent and guardians saying that mental health as well as physical harm to children and teenagers is caused by addiction of the social media platform. Number 3 is they're saying that privacy practices of personal and business nature using tracking tools through third-party websites is a violation of data protection. And lastly, they're saying that authors and copyright holders are saying that because of their large language models, in order to program them, they are using their information. And there's a lawsuit regarding that. Next slide, please. So they are giving a dividend just recently in February 2024, paying out 50 cents, and then it increased to $2.10 for the year with a 0.4% yield. And then as of February 2025, they boosted their payout to 0.525. Next slide, please. On the front side, we can see that it's going up, not quite straight and parallel, but it's going in the right direction. And the sales 2-year estimate is 13.5% and 17.9%. But we can also see up here the sales for the quarter is 16.1 and 36.5 for the earnings per share long term. Next slide, please. When I looked at this more carefully, I actually read some other articles. When I went into Yahoo, their current year as well as next year gave me an average of 13.9. And then when I read, because it was a featured article, Meta, it actually had a historical sales of 26. And so looking at that, I actually took a number that was somewhere in between the 13 and the 26. And then for the historical EPS, the same kind of story. It was at 28 for the article that I read in Better Investing. And then I see this for Seeking Alpha, which is on the right, and kind of took a number in the middle, giving me 20.7 for my historical earnings per share. Next slide, please. So this is the article that I was referring to, and this was the part that I pulled out. So Better Investing gave a 10-year insight, and so it was higher than my judgments call for. And so, of course, if you're very interested in this stock, you can actually do some analysis on your own. But I could have gone a little bit higher, but I chose to stay where I was. But this is kind of the input that helped me to go higher than actually what was stated on the Better Investing platform itself. Next slide, please. And then for the management evaluation, so the management is, first of all, the company is well managed. It has a cash equivalent, marketable securities, and that was on March 31st at $70 billion. It is a grade A company, so we know that it's performing well. We can see that the 5-year average is 36.3, whereas in 2022 is a little bit lower, and then it has steadily risen. As well as the return on equity, it is also rising, which is what we want, and we can see that the debt from 17, 19, 21, and now the average is 15.2. Next slide, please. So the price earnings history, we can see that the stock is currently at $717. And we can see that the 5-year average price earning ratio is 21.9 and current earnings ratio is 28. Next slide, please. My judgment says that it is a buy with a upside downside ratio of 3-to-1. I used the average high as 30.5 and 14.5, I believe, for the low to give me a high forecast of 1,770, telling me that the potential price appreciation is 146.8%. Next slide, please. And then the 5-year potential, which is really important, is we have the compound annual return. So the total return can be anywhere between 12.7 and 19.8%. Next slide, please. So in conclusion, Meta is a well-managed company with a very experienced management team. It's a solid company with dominant social media marketing position and network effect. It's a large size company with strong financial performance and profitability. It's a buy currently at $717 with an upside downside ratio of 3.1 to 19.8 total return. And it's a worthy candidate for anyone to consider looking further at with their own analysis. That's all I have. Thank you.
Thank you, Florentia. Appreciate it. Well,
Sure.
we've went through all of those. I would say kind of quickly, but no, we sort of moved. We got our full money's worth out of it. Anyway, what we like to do is we like to do a review of the stocks and sort of see how they fit on the life cycle. So let's go to the next slide. In this life cycle, it comes from the digital handbook, which really comes from T. Rowe Price, that earnings for corporations pass through a human life cycle of growth, maturity, and decadence. Cheryl, tell us why you have that location on this screen for ARM. And if you're speaking, we can't hear you because you're muted.
Sorry about that. That you can see that ARM was one of the newest publicly traded companies in this group, and also the expansion of revenue growth as well as earnings per share has been explosive, and so that's why I put them there.
Okay. Florentia, let's come back to you and tell us why you have that location for Meta.
So Meta is a large stock, but it's sound, and the projections all point to the potential of it still having a lot of potential to grow a lot more. So although it's mature, it still has the potential to grow a whole lot more in the future.
Okay. Looks like Larry dropped off, but my guess is Larry probably would have said about the same stuff about Google as you're saying about.
I'm on the,
Oh, here you are. Go ahead.
I'm on the phone. I'm on the phone. We had a storm here and I lost my internet connection. But
All right. You want to tell us why you picked that
um,
location for Google?
yeah, well, their growth rate seems pretty consistent right now, but it's hard to see how such a large company like Alphabet can continue to grow rapidly. So I put it up in the mature zone.
And Ken, you want to be able to talk about really sort of a life cycle on the next slide, but we just have it pointed there. So let's move to the next slide and let's let Ken tell us what he has going on here. There we go, Ken.
Okay, so I recently came across a Google sheet tool that was developed by Brian Feraldi. So they kind of look at the business cycle in a similar manner, although they have 6 stages to theirs. But what I found interesting is that they evaluate where a company is on the life cycle based on answering these 5 questions about revenue, gross profit, operating profit, net profit, and share count. So in evaluating that for Molina, you can see that it really seems to fall on that, I guess, mature area that I would say the Section 5 area, capital return area of the graph. So, based on the information that I was able to correlate for it. So I just thought it was an interesting way to evaluate the business cycle based on the information they had out there.
It is. It's quite interesting. Okay, let's keep moving and let's go to our backup. There we go. Now it's time for you. We've been yakking for about an hour and a half now, and it's time for you all to be able to tell us what you think about it. And Cheryl will release a poll. It doesn't cost anything. It's not necessarily the one you think you want to buy right now, but which of the presentations interest you enough that you're like, boy, I want to go look at that myself and do my own research. And that's sort of the intent we're trying to take a look at it. So go ahead and vote away. We have about 50% of you all making voting. We're getting up over 60. Oh, it looks like we could be having a runaway here. 65. 69. Can we get up over 70? Will someone put us over 70? We got to 71. We'll give one more. See if we can get one more vote. Oh, we got a couple more. They're coming in. Dang. Those late returns are coming in from Hawaii. Okay, why don't we close it off? I think that's a good time to stop. And there you have it. In a runaway, ARM is our winner. So with that, Cheryl, you will get the bouquet of flowers that we hand out to everyone. We just have to get the budget for that approved first. But other than that, we'll keep going. I don't see, do we have any questions in the, I don't see any questions. If anyone has any interest, I think I saw some hands going up now. So let's take a look at the hand people. Who do we have? Thought I saw someone with the hand up. Oh, we got a couple. All right, Lee, I'm going to unmute you. So Lee, why don't you take your question? You're self-muted, so go ahead and unmute yourself.
I wanted to mention on slide 84 for ARM, for the conclusion, the buy information is misstated. Probably wasn't updated.
Okay. Have you heard of ARM? Do you know anything about it? Any comments?
No, it's following it for a while. It just seemed like the PE was rather high, so but I put it back on my watch list after Cheryl's presentation. Quite informative.
Yes, it was. Okay. Well, thank you very much, Lee. I'm going to mute you. And Helen, I'm coming over to you. So if you want to unmute yourself and ask your question.
Hi, this is Helen. I didn't see a chat option. No place to ask questions.
Huh, you know what? I think I sort of noticed it looked kind of odd. We could have set it up kind of wrong with that. So anyway, yeah, we'll do that. So if you have a question or anything.
No, just that comment. Thanks.
Okay. Well, thank you very much, Helen. And AP, it looks like you had your hand up. I'm going to unmute you. So if you want to go ahead.
I did. This is Anitra. I was going to say the same thing. There is no question box on the control panel. That's it.
Yeah. Okay.
It's showing up on mine as well as the chat. So,
but I can see why it is. When I was trying to send text messages to people, I had to sort of do a little workaround. So there was there's something in our setup that we didn't get right today. This is what you get when you have volunteers putting this together rather than pros. So we try our best. Anyway, any questions about any of the stocks or stuff like that? I know we're going a little long, but this is a great time to be able to chat about it if you're hanging around this long. And also, please make sure to to download those handouts that are over there in the control panel, including the completed SSGs. So I don't see any more. Let's just keep moving, Cheryl.
Okay. Let's see. For some reason, the poll thing came back out.
Yeah.
So let's hide that. There we go.
And we need
All
to get
right.
to slide 109 or 110.
Yeah, I'm on.
It shows 80. It's showing 85.
Okay, sorry. You're right, because I went to.
There we go. Let's go one more. I think we already voted, so we this one two
Got
more.
that.
There we go.
There
So
we
here's
go.
how you can be able to reach us if you need it. And there's a picture of us, some of us, the presenters, as we were at BINC last year in Chicago, which is where BINC is going to be next year. So that's the in-person BINC. But again, we've had a wide range of people helping out to make this a great success. Thank you all. And there's how you can be able to reach us either in the Maryland chapter, the DC regional chapter, or here at Digging into BI. Next slide. Here's how you can also join our mailing list. You won't be bombarded with stuff, but that way you'll at least get the notices on when we're going to be doing this program, as well as some of the other programs that the chapter has planned. Next slide. This is volunteering. This is our pitch to be able to have you come be a part of it. If you're, if you like this and you want to be a part of this, the way this works is by people volunteering, like all of us here, to be able to put it together. We're stronger as a community when we interact with each other. We're not in person, but we do get a chance to be able to sit there and hone skills, develop relationships, and be part of a larger community. So please consider being a volunteer. One more slide. This is what's coming up in August. The stock to study is going to be the Walt Disney Company, and the undervalued feature is Amgen. And then we're going to have Constellation Energy as one of the two other stocks. The other one is a to be determined. But that will be on Monday, August 4th, so just 3 weeks from now. Next slide. These are the dashboards. I've been horrible. I haven't really updated anything in a long, long time. So I've got to make sure that's getting current. One of these days I'll get around to it, like maybe even tonight, but I usually take a break after I'm done with this. Next slide. Here's the links to all of those. Again, you don't have to be a member of have a subscription to Manifest. Those are free public dashboards that you can sort of track how things have done over the last 5 years. Next slide. And this is the final. Just a reminder that we're up on YouTube. You can click on this location to be able to take you right to the YouTube channel. Also, please make sure to download those handouts and the like. We're really glad that you're here. I know we went longer than we intended to, but we just had good stuff tonight. That's all. That's the way I look at it. And very good presentation. So thank you all to our presenters. Thank you for being in the audience. Please come and join us next month when we will be digging into the BI again. Good night, all.
Night.
I'm going to leave it on for a couple of minutes in case people are still doing the handouts.
And any of
So
the people in the back
please.
room, if you leave, just leave yourself. Don't end the webinar for all.
Yes. It's weird what was said about the not seeing the chat or the question.
Yeah, no, I see exactly. If you look at the panel, you can see chat. You don't see questions. You should have questions in there.
Ah, I see.
And so maybe it's under file or options. Yeah, if you go under you see how it says file and options. Attendees can view the attendee list. We ought to open that up. I like seeing who the other ones are. And then attendees can ask questions. So if you click both of those under options, you will
Okay,
get that.
there's the question box.
And then I was wondering how to do that, and I saw Carol Thine do it, that attendees can view the attendee list. I think that's good. I think sort of helps connect us. That way you don't, if someone else in your club is there, it's nice to know that.
Right. No, I agree. So I'll have
So,
to make sure next time. I don't know if it continues with hitting the same option, so I
yeah,
will
we may have
have
to
to
overdo it.
check that.
Anyway,
Do a check maybe the night before.
okay.
All righty. I think everyone should have had ample time.
Correct. Let's let them go. Good night.
All righty. Good night. Thanks, Kevin.
Bye.